The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Will rising yields put rates back in charge of stocks? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Emily Grafeo. We're kicking you off to the closing bell here in the U.S. as we close out this week and as we close out this month. Take a look at how the S&P 500 is trading right now, up about 0.6%. The tech stocks really leading the way here. Not too much movement. It is a Friday, but we're still up higher on that tech-heavy index. When you look at how the S&P is shaping out for the month, though, it's looking to be the quietest month of 2025, at least on a total return basis. The Russell 2000 index is something I want to highlight today. Small cap stocks getting crushed under the pressure of those higher interest rates. And speaking of rates, the 10-year yield now at 4.7% remain as those long-term yields do continue to rise.
This week really was a big credibility test for the big market themes of the year. The AI trade, the Iran war, the U.S. economy, the Warsh-led Fed, the price action. It shows just how much some of those actually came up short. We close out July with chip stocks still out of favor, Microsoft and Amazon back in good graces, and a lot of indecision on everything in between. The iShares Momentum Factor ETF about to log its worst monthly performance since 2022. While betting on more volatility, that was the best performing long-short factor strategy, up 16%. And as the calendar flips from July and into August, don't expect things to tamp down. August and September, historically, even more volatile. We've talked about the hedging we've already been seeing around corporate credit. Well, guess what? Public equity traders now doing the same. A gauge of normalized 3-month put-to-call skew on the S&P this week, jumping to the highest since April. And now with the bulk of the big tech earnings now out of the way, the market's going to likely be driven more by renewed focus on some of those macro risks, like that 20% jump in crude oil this month. Or how about the weakest week for the dollar since April? Or how about the biggest jump in 30-year Treasury yield since 2024, which now has bond traders willing to pay up the highest premium since March to protect against a further climb after Warsh dropped the ball on his fingallying of his inflation-fighting credibility.
The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down. I mean, the fact that the 30-year yield went up, the 10-year yield went up, and 2-year yields dropped really was a sign that that there was a loss of credibility in from that press conference.
A lot of big questions right now about where rates go next, and I assume that means where stocks go too.
Yeah, I mean, you look at the 1-month performance of the 30-year yield, and it's remarkable. But I also want to zoom out to just where we are on a broader basis, because the 30-year Treasury yield now is sitting at its highest level in quite some time now, sitting at that highest level since 2007. The hedging costs, like you said, Romaine, are going up for corporate credit, they're going up for equities, and they're also going up for those Treasury rates. All of it as traders kind of consider whether the Federal Reserve really has a hold on inflation. We know that those inflation expectations show up on the longer end of the curve, and we're seeing that, Romaine, right now in the price action of the Treasury market.
As we kick you off to the close, to round out the weekend, round out the month of July, let's get right to Phoebe White, head of U.S. rate strategy over at UBS. And Phoebe, we should point out, for this big move that we've been seeing in the secondary market on long-end yields, the expectations, at least amongst a lot of the swaps traders, not a whole lot of conviction that we are actually going to get rate hikes anytime soon. I am curious what your base case over at UBS is now that we've heard from Kevin Warsh.
Romaine, thanks so much for having me on. So our base case is actually that the Fed can stay on hold through the rest of the year. And while, yes, the Wednesday was a big sort of credibility test for Warsh, I don't think the decision to stay on hold was a policy mistake. I think there was just sort of a vacuum in terms of his explanation of why the committee stayed on hold, and there's a lot more he could have said on that front.
With regards to the big move that we had in the steepening of the curve, particularly on Wednesday, I know that kind of subsided on Thursday and kind of back and forth to a smaller extent today. Do you think that that becomes the trend long term, or do you think that's just sort of the short term reaction and things will normalize to whatever normal was pre-meeting?
I think there are 3 key reasons we saw long-term rates moving so much higher this week. The first is on this point of uncertainty, right? This is a Fed that has removed forward guidance. It's also not explaining what its reaction function will be going forward. And again, we didn't hear a lot of description in terms of what took place in that committee meeting on Wednesday. So higher uncertainty means higher structural rate volatility. That justifies higher term premium. To an extent, it also justifies higher inflation risk premium, although I would argue we actually haven't seen long-run inflation expectations moving materially higher. And then the third piece is that this uncertainty comes at a time when we've seen upward pressure on term premium just due to the persistent concerns around duration supply dynamics in the market. So all of those things, I think, will stay in place here. The big question for the level of yields and whether we can get a bid for duration is whether we start to see some actual progress in the economic data here the next few months. And we think we actually will.
I do want to ask, though, with less forward guidance, where do you think the market is now going to fill that void and look for clues on the path of monetary policy? I mean, we did get 3 dissenters speaking this week, talking about how they want to go tough on inflation. Do you think that that Fed speak holds more weight now?
Well, Emily, I think the Fed speak does hold more weight, and especially since we're not hearing that much from Warsh, it means the other speakers will carry more weight. So we heard from the dissenters today. I think it'll be important to hear from those on the committee who did not dissent. What are the arguments for staying on hold here? And I think there are plenty of arguments, again. Between the lines in terms of everything that Warsh said on Wednesday, there is this argument that we have seen term premium pushing higher, real rates are sharply higher, markets are partially doing some of the work for the Fed. The second thing is, even as real rates have been climbing, between that June and July meeting, inflation expectations based on market measures actually moved lower. And then the third piece is, what are the other inflation measures that the Fed is watching? Warsh mentioned we're looking at a broader range of measures. He hasn't revealed his cards yet in terms of what the conclusions from these task forces will be and what kind of high frequency data he's looking at. But I think there are a lot of reasons to believe that some of this run up in inflation in the first half of the year is unlikely to persist into the second half.
I do want to get your thoughts on some of the moves that we saw this week, particularly with the weakness in the dollar, which is probably maybe a bit of a less of a function of what's happening at the Fed and more of what's been happening overseas. But is there some correlation that we should maybe be looking to with regards to the strength or weakness of the dollar going forward?
I think there is some correlation there. And I think that is one argument that part of the move this week could be related to credibility and certainly higher uncertainty. This is something that we've been seeing over the last couple of years when we have this injection sharply of term premium further out on the curve that actually hurts the dollar, right? If yields are climbing more from a perspective of growth is going to be quite strong, that helps the dollar. But anytime you have more uncertainty around policy, any of those credibility questions, that does hurt the dollar. So that is not the trend that we expect to continue. We're actually bullish on the dollar medium term. We're holding on to that view. But I do think that some of the move this week in the dollar is a reflection of what happened on Wednesday.
Phoebe, have a wonderful weekend. Always great insights. Phoebe White, head of U.S. rate strategy over at UBS, as we count you down to the closing bells on the weekend for the month of July. And it wasn't all just tech earnings this week. We got some incredible earnings out of some of the big oil and gas majors, including Chevron. We're going to catch up with the CFO, Eimear, when we come back after the break. Records all around, but a lot of questions going forward as to whether this windfall is just a one-off.
Plus, from the oil fields to the biotech landscape, Illumina CEO Jacob Thaysen joins us to recap his company's earnings report and what's driving the guidance boost.
And Emily, I know you love boxing, right?
And
you probably love MMA even more. I don't know how much you love Jake Paul, but we had a chance to catch up with him. His MVP Fighters League, well, guess what? It's merging up with the PFL into a big super league that they think could take on Dana White's combat empire over at the UFC. You don't want to miss that. This is The Close on Bloomberg.
Well, AI is changing the way we think about security, especially when it comes to our phones. Glide Identity is a digital identity platform designed to verify users without the need for that constant one-time passcode. It's partnered with Verizon to bring a new layer of security for how we sign into our phones. Joining us live are Eran Haggiag, CEO of Glide Identity, and Scott Lawrence, CPO of Verizon Business. Great to have you both here. Eran, let's just start with you. Talk about, how far away are we from a world where you don't have to get that text message saying, accept this, so that you can actually log into all of your accounts?
Yeah, so finally we're very close after so many years that we are getting this annoying one-time passcode. We are about to launch in public beta this capability throughout the US with about 80% coverage. And this is not only much more convenient, it's way more secure.
And Scott, I do want to bring you in here because Glide is launching with AT&T, T-Mobile, and Verizon, all the major, telecoms aligned behind this. Just talk about why this is a priority for Verizon. Did it come from a place of, really, I guess, fearing what AI can do when it comes to cybersecurity and safety?
Our focus has always been to deliver trust to our customers through network-based security. And the partnership that we have with Glide really enables us to build off of the authentication security we already provide today for millions of customers that use their mobile phone on the Verizon network. And it combines Glide's eSIM cryptography technology, which really simplifies the end user experience. If you think about the conversation we had about getting that text to put that 6-digit code in, we now create a simpler, frictionless end user experience, put it into the transaction itself, and you accomplish two things. You improve security and you enhance the customer.
So give me a sense, though, Scott, when we talk about enhancing the customer. So, is the idea that not only are you protecting against what would be, phishing attacks or other sort of people just trying to, get a hold of, whatever sensitive stuff apps I might have on my phone, but does this also address some of the other issues just with, spam calls and other things? I think we've all seen this huge uptick in being inundated with all of these things, whether it's through text, voicemail, calls, et cetera. For some of it's been relentless.
Look, I think we've seen growing fraud and risk, specifically cyber security risk in things like voice cloning, voice spoofing. Social engineering has become so easy to do. Even the use of deep fakes to represent your identity. You want to make sure that any time that you're logging into a sensitive application or you're conducting a payment transaction, that it's actually you that's doing it and you're not opening yourself up to risk. And that partnership with Glide offers that secure, trust-based relationship. Yeah. Beyond that, we're also doing things within our network to control the spoofing and the spamming and ensuring that you're not getting those annoying robocalls all the time.
Yeah, and it goes, and Eran, I'm going to bring you back in this, because it's more than just robocalls. This is a threat. And I am curious, and you have to kind of explain this to me. I'm not as smart as you, so explain it to me like I'm a 5-year-old. So, how does this actually prevent or at least reduce the kind of things that I'm getting right now with regards to, it's hard to even know, what I'm getting sometimes. Is this really from the person that it says it is? Sometimes it looks like it's from people that I might even know. So what's the technology doing behind the scenes that is mitigating this risk?
Yeah, so basically what you need is to have a hardware root of trust. So the problem with all the identity in general today, when you have passwords and one-time passwords, they're phishable, as you said. People can steal it. They can leak in different, dark web websites, and people can intercept your one-time password, also trick you to send them. Somebody can call you from a support of your bank or your crypto exchange and ask you for that password, and you would give your one-time password. What we did is we were looking for this hardware root of trust that is rooted in cryptography. This is like in math, something that AI cannot trick. And luckily enough for Americans and for humanity, the telecom have distributed these SIM cards and eSIMs that have this cryptographic key in every pocket that we have. What we had to do is just to work with all these telcos together to align and make a solution that financial institutions and banks can use now to know that you are you without you putting up any code.
So your technology, just to be clear, your technology now can do this, or you're about to have proof of life for this on a commercial basis. You mentioned AI. There's a lot of talk about the pace of how AI is improving, and now we're already talking about quantum and everything else. How fast do you have to go and to update your technology to make sure that it stays ahead of the potential advancements that we might see in nefarious type of AI use?
Yeah, so this is a very good question, and this is why I really want to thank both Verizon, AT&T, and T-Mobile to work fast with us to get this available so we can help Americans to be protected, right? You want to make sure that your bank is going to be using this technology as fast as possible to protect you, right? Regarding quantum that you just mentioned, so quantum technology is something that we are planning to have an update next year to make sure that this technology is going to be also quantum safe. And this will allow a AI safe, quantum safe, agent ready authentication and verification mechanism for Americans.
All right, well, real fascinating stuff, and I think could certainly be of use to a lot of folks out there. Eran, great to meet you. Eran Haggiag, the CEO over at Glide Identity, and our thanks there to Scott Lawrence, the CPO of Verizon Business. When we come back, we're going to turn back to some of the big movers on the day, and that includes Apple to the downside. A miss on several key metrics here in the most recent quarter, despite a big product lineup release up ahead. We're going to ask a key analyst out there on the street as to exactly what investors are reacting to today. That's coming up next, right here on The Close, right here on Bloomberg. Time now for our top calls. Some of the big movers on the back of analyst recommendations. And we want to start off today with Circle. Mizuho just trimming its price target down to $45 from $50 here. The analyst says that the Clarity Act here in the United States unlikely to be passed this year because of a lot of unresolved issues here, potentially helping out, potentially hurting the stablecoin maker. Those shares down about 3% on the day. Next up, let's take a look at Roblox. Cut the market perform over at BMO. The price target down to 45 from 100. This on the back of those earnings. The analyst taking note of a shift in engagement from last year's high. Take a look at the shares. No high there. In fact, having their worst day on record. And finally, Apple. Rosenblatt keeping its neutral rating on the stock after the earnings, nudging the price target up to about $300 a share. That's actually below where it's trading right now. The analyst does cite Apple's supply chain constraints along with tough iPhone comps, saying that that could keep a lid on the stock for some time. Those are some of our top calls, with Apple down about 9% heading into the close. We bring in the person behind that last call, Barton Crockett, Managing Director and Senior Research Analyst over at Rosenblatt Securities. The quarter overall, not awful, though we should point out most of the key unit segments did come in a touch below analyst estimates. But it seemed heading into this print, there was a lot of optimism, not only about what Apple would report for the 3 months past, but the idea that the months up ahead would actually maybe be a little bit brighter. Are you not seeing that?
Yeah, I mean, I know that the stock has been really a great performer. And, we've been sitting a little bit more cautiously with a neutral rating. And, our concern is pretty basic. I mean, it's a great company. But the iPhone performance this year, with the 17 powering 20% plus growth in iPhone revenues, they've had these in the past, and always the next year things really kind of decelerate substantially to slightly up or down against a difficult comp. So we think we're likely to see that next year. With the stock trading, at well in the 30s kind of forward PE, which is elevated versus its past history, and an EPS normalized growth rate that we think is in the low double digits. It seems like the valuation is stretched for a reset in the growth trajectory. So, at this point, we're more cautious. We were coming into the report, and we remain coming out of it.
Talk to me a little bit about the iPhone refresh, which we're expecting to get more details about in September. Is there a sense, because the narrative right now, certainly based on what Bloomberg print reporters are reporting, as well as some of our competitors, the narrative seems to be around the supply chain issues, the cost embedded into that, and whether that holds back any sort of upswing they would have had in terms of actual unit sales of new iPhones.
Yeah, absolutely. I mean, they've guided for the September quarter growth to be 9 to 11%. I think that's relative to 16% they just put up in the June quarter. So that at the high end, kind of 5 percentage point deceleration. About half of that is foreign exchange, and the other half is really supply constraints. They're not able to ship and meet all the demand for their hardware, essentially, including the iPhone. And so that's definitely an issue, and it's just a brave new strange world where Apple's running into these kinds of things because we're used to them being able to get what they want when they want it, having tons of leverage over the supply chain. Now with all this AI demand kind of working through the system, they're on kind of the tougher end of that. They're seeing higher memory prices, and they're not getting what they want when they want it. Partly they're not expecting the demand, but I also believe in terms of planning is for as much demand as they've been seeing, which has been really surprisingly large on the iPhone. But, the commentary around other devices, that's as much as anything, just, the competition with the AI kind of mechanisms working through the supply chain.
I do want to get your thoughts, Barton, on Apple's AI strategy and just how much you think this company needs to deliver a compelling AI experience to continue to grow rather than just another hardware upgrade.
Look, I think that the table stakes have been set for good AI. And, I think you've seen that in the Android ecosystem, really supported by what Alphabet, Google's been doing. And Apple leveraging the Google Gemini technology is finally pulling it together and coming out with a great experience. And I'm not sure that is at this point something that's going to drive a big uptick in sales. I think consumers get AI features through their apps, they get it through their Android phones, they get it through all of the websites that they're going into that are AI equipped. So AI is everywhere, but I think if you didn't have state of the art, you'd be disadvantaged. And I think what they're delivering is a personalized kind of experience that is compelling. So applaud them, like many things they do a good job of it. But against a 20% iPhone sales comp, I think that stands, the comp stands tougher than the AI feature set in terms of what we think happens next year.
Our thanks to Barton Crockett, Managing Director and Senior Research Analyst at Rosenblatt Securities, as those shares of Apple do head for their biggest drop since April 2025. Coming up, shares of Chevron are on the move, Romain.
Yeah, we talk about some of the big moves in the market today, and it was kind of interesting. So much focus this week was on the tech names. We actually had some relatively encouraging earnings reports outside of the tech space, and that included with some of the energy companies. That was expected, given the big jump up that you saw in oil and refined products. But there's a big question: is this just kind of a one-off because of the war? What happens if we do get a resolution? And then where do prices go next, and where the stock prices go next?
It is interesting to see the movement today, particularly when we have yields moving higher as well. So oil's up, yields are up, and those energy companies are benefiting from that.
Yeah, absolutely here. And of course, we heard from Exxon earlier today. We also heard from Chevron. They actually had a record quarter on the profitability side. Revenue wasn't too shabby either. And a couple of acquisitions and some other deals that they've made, providing a bit of a buffer. We're going to catch up with the CFO of Chevron in just a moment after the break and get her insights on not only where the company is going, but, well, quite frankly, where oil prices might go next. That's coming up next, right here on The Close, right here on Bloomberg. Keeping an eye on shares of Chevron higher this afternoon after the oil and gas company posted a record second quarter results. It outperformed expectations. They used some of that cash to pay down debt. Things right now seem to be going well on the price side, but still some big concerns about what's been going on in the Middle East and also in Kazakhstan. The CEO, Mike Wirth, speaking on a conference call earlier, says little evidence of demand destruction. We're also been keeping an eye on the situation in Kazakhstan, and we learned less than an hour ago that the Caspian Pipeline Consortium says that it will continue oil operations after considering an indefinite halt that would have threatened the Kazakhstan's ability to supply the world with a crude. Joining us right now to break down what happened over this past quarter is the CFO of Chevron, Eimear Bonner. Great to have you here on the program, Eimear. And before we get to some of the quarterly numbers, I do want to ask you about the situation with the CPC in Kazakhstan. Mike Wirth addressed this on the conference call earlier today. It looks for right now that he did seem to confirm that Chevron ships had been loading up earlier this week, and based on what we're reporting right now, that the CPC will continue to allow ships to continue to be loaded up. Are you aware of that?
Thanks, Romain. Thanks for having me. Specifically on CPC, the terminal is open. Yes, that is what our understanding is, and the loading is continuing as well. And our asset in Tengiz that exports oil through that pipeline is also operating. So that's the news that we have.
Have you been sending?
With regards to the
Go ahead.
The quarter.
I'm sorry.
Can I maybe move on to the quarter? We had a really strong quarter, strong operational performance across all of the assets around the world. The key assets were at or near full rates for the entire quarter, so that strong operational momentum resulted in record production in the US for the quarter and record refinery throughput for the quarter as well.
Give me some sense here as to sort of how you sort of map out the future, knowing that some of this is obviously coming from the temporary bump up that we've seen in oil prices. If we believe it is indeed temporary, we're averaging more than $100 a barrel in Brent in the past quarter here. Is your expectation that average prices will sort of remain there for some time?
Well, the reality is that there's quite a lot of volatility right now, and we've seen that over the last 5 months. So that volatility, where there's geopolitical or market volatility, is something that we have to operate within. And so what we focus on is what we can control. And, you know, we don't count on prices. We don't set prices. What we do is we produce into these markets, and we want to ensure that we're producing all the energy that we can and delivering that energy that the world needs. And so that's what we've been focused on.
Well, you got a 20% bump up in production is what you've telegraphed to the market, though I assume that is tied to your general outlook on prices and as well as supply coming from other areas?
The 20% production was part of the plan that we had coming into the year. So we have not adjusted our production in light of the prices. We had a plan in place. Our plan was assumed growth, growing in the Gulf of America, so in the US, growing in Guyana, growing in the Eastern Mediterranean. So our plan assumed growth and will continue to grow this year, 7 to 10%. So we did not change any of our plan because of prices. We take a long-term view, a through-the-cycle approach to our plan.
Well, I'm curious, with regards to the long-term view, and this is still on the situation going on in the Middle East. I mean, you signed accords with Iraq, a couple of weeks ago, obviously with them focused not only on production, but also on the potential, maybe, of trying to find a pipeline that could actually bypass the Strait of Hormuz.
Yeah, so we have been in active discussions with the Iraqi Prime Minister and his teams on a number of options for the future. So this is something that we work well in advance. I mean, part of our business is that we produce 4 million barrels of oil per day, and we have to replace that. So we're in a depletion business, and so stacking options for the future, competitive options, is part of doing business. Iraq has some of the largest discovered resources in the world, so we like Iraq for that reason. We have exclusive negotiations underway for an asset in West Kurna 2 that is a producing asset. So any progress there would come with immediate production. We also have another area called the Nasiriyah field that offers opportunities for growth as well. And then as part of kind of an imagining what a business might look like there, we've also discussed what another export route or export alternatives out of Iraq would look like. So this is all part of our efforts to ensure that we have competitive options stacked up for the future. And at the end of the day, we will have to make decisions on those at some point. But that's what we're doing in Iraq, is looking at these options with pace.
Well, let's come back a little bit closer to home here and talk to me a little bit more about the Guyana assets and the idea of when you start to see that show up in terms of some sort of meaningful contribution to the top and bottom lines.
Well, Guyana is meaningfully contributing today. It was part of the Hess integration. When we closed the transaction last year, we were able to integrate their assets. Guyana was one. It's a terrific asset. We're very pleased to be part of the venture. It's got a strong queue of projects. It's very well, it's performing very well. We also integrated other assets into the portfolio. So we have the Bakken field, which is in North America. We have integrated that into our shale business. And then we also had Gulf of America assets. So the Guyana asset is a major asset within that portfolio. But that is part of the reason why we've been able to grow so much year over year.
How much of that 20% production growth number how much of that is coming from Guyana?
Well, overall, about 250,000 barrels a day is the potential of the Hess portfolio. So that's contributing. That would be on an annual basis, so half of that.
You obviously are getting a lot of credit here for helping with that integration, particularly on the cost side here and realizing some of those synergies here. You came in above target, at least what you had originally promised, with regards to some of those cost savings and synergies. Where did that extra come from?
Yeah, well, there was a number of things that we looked at as part of integration. One, we had a number of operations that had footprint that overlapped, and so we took advantage of that to really streamline, basically bring the best of both. I think the two areas I'd focus on is the Gulf of America and the back-end assets. So when we integrated the Gulf of America assets into the portfolio, we were able to share costs such as shore bases and logistics support to those offshore fields, and with that comes cost reduction. So that was part of the synergies. In the back-end field, we were able to look at the development plan and ensure that we could keep the same 200,000 barrels a day going with less rigs. And so that was a combination of best practices that we deployed from the Permian asset and the DJ assets to the back-end. But we had some of that come to our Chevron legacy assets as well. So those would be two examples operationally of where we were able to deliver synergies. We also had some corporate costs, some put options that we cancelled. And then finally, we also had a lot of net operating losses that we were able to use given our large North America production. So those are the things that enabled us to go from $1 billion of synergies to $1.5 billion of synergies.
So overall, as we kind of sort of wrap this up and we take a look back at the quarter, the big windfall here, you obviously used a lot of that money to pay down some debt, which investors seem to like as well. When you look at some of the disparities, though, that we see with regards to the trajectory of prices in the oil space, the crude space, relative to some of the refined products, the idea that some of those fuel product prices are staying higher longer than what we would see with regards to some of the unfinished products here. Are you doing anything differently or more aggressively to try to capture a little bit more of that windfall while you can?
No, we're not doing anything differently. We're focused on operating with excellence and obviously trying to bring energy to the world, products to customers. What we focused on is optimizing the levers that we have. You've seen the quarter that we had a U.S. production record. That was something that we were able to deliver. We also delivered a record in refinery throughput, and so that enabled us to capture the margins. But it comes down to optimizing the levers we have, the crudes we have, the kit we have, and maximizing value that way. And I highly expect that we'll continue to deploy some of those learnings and some of those gains operationally in the quarters to come.
Eimear, really appreciate you taking time for us. Eimear Bonner, the CFO over of Chevron. The share is up for a third straight day, a fourth straight week as Chevron closes out the month higher by about 20%. Meanwhile, moving in the opposite direction here on this day, we're going to talk about the world's largest record label, Universal Music Group. It's our stock of the hour. It's down 17%, and it's up next, right here on The Close, right here on Bloomberg. All right, shares of Universal Music Group having an awful day. The world's largest record label missing expectations for subscription revenue growth. Bloomberg TV markets correspondent Nora Melinda joins us right now to talk a little bit about what's happening. I mean, to say that Universal Music Group is the largest just kind of understates it. I mean, basically, you name a mega artist out there, they're probably under this umbrella. Have we all just given up on music?
Yeah, what's the artist for you?
Like current artists? Well, I was listening to Supreme Clientele coming in this
there
morning.
You go. There you go.
So,
name a name
bong,
and
bong,
artist.
Bong, you're well, wrong.
The names go on and on and on.
They do.
But this is a company that's really been struggling. I mean, if you
when
think...
is Ghostface coming out with a new album? Then I'll start. ...
Yeah, we'll have to get back to that one.
Why is the stock down, Nora?
The stock is down because we are seeing data that shows that streaming is slowing down. I can't personally relate. I keep my earbuds in all the time on the train.
Yeah.
But we are seeing a bit of pullback when it comes to streaming. And this is also just an industry that a lot of people have had their eyes on, given the fact that we've been seeing artificial intelligence coming in and essentially people making songs trying to rip off from actual artists and putting out content that's not actually coming from these artists themselves. So that's also been hampering the industry more broadly. But analysts on Wall Street saying that there's no way of sugarcoating these earnings. JP Morgan saying there's no way to sugarcoat this. This is the second straight quarter that we've seen a miss from Universal Music Group.
Wow.
But the company is saying hang in there. The second half is going to be better.
Music?
I do, yeah. I'm a Spotify Spotify user.
Okay.
Likewise.
Does Bill Ackman, is he feeling vindicated right now? He was a big bull. He was a big music bull, but he got out of his position in this company.
He hopped out of this position. Of course, he was trying to take over. He put in an offer for a takeover for a Universal Music Group. He wanted to bring the company to be listed in the United States instead of Amsterdam. The company then rejecting that offer. And we have seen that the company's been down pretty substantially. Take a look at the year-to-date scope, down about 37% so far this year. So we're seeing the group really being pressured more broadly, and the industry trying to continue to figure out what the next step forward is. So it's about whether or not management is right and the second half will be better. And they talked about seasonality and the idea that it all depends on when artists are actually releasing their music. So the management was saying on the earnings call, it also depends on when they are pushing these songs out. But then you have Wall Street saying, hey, maybe that's not enough, and it could be more structural, fundamental issues that are going on.
I like him. I'll listen to him.
Hey, there you go.
We got Chris Stapleton on here. Is he still making music?
Hopefully.
I don't really follow
Justin
country.
Bieber's in the
listening to the new Strokes album.
Wow.
Family.
Selena Gomez.
Nora Melinda.
T-Swift.
Wow.
Thank you, Nora. That was Nora Melinda.
No wonder the stock is down. 10 minutes away from the closing bells to close out the week, to close out the month. Romaine Bostic here with Emily Griffeo.
This has been actually a quiet month on the index level, Romaine. If you look at how the S&P 500 has performed in July, it's actually pretty much unchanged. So
unchanged,
what were we even
but does
doing
that
here
ignore the gigantic black hole that's underneath the surface that seemed to have like dragged a lot of stocks down with it?
It's funny how that works sometimes when we come to month end. We are getting a rally, at least today, though, for the S&P 500. We're up about 1%. That is off the session lows. We are climbing into the close. About 10 more minutes left to go in this week. Tech stocks also in the green, Romaine, up about 1% on the NASDAQ 100. Equities just not really paying attention to the steepening of the yield curve, to the rise in long-term rates. I do want to highlight that 10-year yield at about 4.7%. And small caps, too, getting crushed. Maybe the small caps are feeling the weight of higher interest rates.
Yeah, it'll be interesting to see, again, as we kind of get deeper into the next month, and particularly given that kind of earnings season, at least with the companies that we care about, it's kind of over. We still get a few big ones over the next couple of weeks with SanDisk and Western Digital. We still need to hear from NVIDIA towards the end of August there. But, I mean, we've heard from the hyperscalers. We know what they had to say. We've heard from some of the chip makers. We've heard what they have to say. And at least for right now, the market appears to have voted. The big question is now how the market actually digests all this and resets for the next few months into the rest of the year. Veronica Willis joins us right now, global asset allocation strategist at Wells Fargo Investment Institute. And that is where I want to start. I mean, despite the sell-off that we saw in a lot of these names, earnings obviously weren't bad. It was just kind of, you had these expectations that were just so high coming in, you were bound to get some sort of pullback, if you will. And I guess that is my question, is what we've seen over the last few weeks, should we just treat that as a pullback, as a potential buying opportunity if you are indeed a believer in this long-term tech story?
Yeah, absolutely. We've, recently moved favorable on the tech sector, and we're really telling investors to, when there's a pullback, add to that exposure to tech, use this as an opportunity, because we think over the long term, and especially over the intermediate term, that tech is going to do really well here.
But it gets to this idea, are people being more selective now? Because I felt like that was a narrative months ago, and then you saw that in a lot of the dispersion in the market in terms of like the single stock performance, and now there's been a lot of data showing that that dispersion is broken down, and now you have a lot more correlation in this market.
Yeah, I think what we've seen is a shift in how investors are being selected. So there was kind of this, any large company that had an AI focus was a beneficiary. Now I think investors are being a little bit more conscientious of who's really going to be a beneficiary here. It's not going to be every tech company. So not just who's spending on AI, who's really backing it up with those earnings.
When you think about higher yields and, the little bit of information we got from the Fed this week, how does that impact the tech trade? Because for a while, there was this theme that, the tech stocks wouldn't be able to handle the 10-year at 5% potentially.
I think we're seeing that at least at this level where rates are, stocks are going to be okay. I think stocks are going to do okay even if we see a little bit higher interest rates. I think if you start to see above 5, yields really getting higher, that's when some of the stocks might be hit. But I think where we are now, at least investors are comfortable enough with that to feel like earnings can still do okay.
What is your expectation for where Treasury rates are going to go for the rest of the year?
I think, kind of at this level, maybe a little bit higher. I think the bias is going to be to the upside on yields as opposed to the downside. So maybe a little bit elevated around where we are currently, possibly a little bit higher.
Where were you on Wednesday at 2:30? Were you watching Kevin Warsh? Because I was absolutely fascinated by this, not so much because of what he said, but the response to it. I mean, he said all the right things, but clearly it was the way he said it that seemed to rattle the market and raise a lot of questions about just how committed the Fed would be to actually fighting inflation. I mean, what was your kind of takeaway coming out of that?
I think what we're seeing is the market, and especially the bond market, is concerned that there's going to be less transparency into what the Fed is thinking than what we had in pretty much the post-financial crisis era. So they're really kind of recalibrating how closely are we going to have to look at the economic data and try to read the Fed's mind if we're not going to get all of the information, all of the transparency that we used to get from the Fed? I think that's really what we were seeing with the market reaction on Wednesday.
There's a lot of volatility baked into this market, bond markets, stock market, now, of course, even in FX. Is this kind of the new normal? We just have to get used to these types of big volatile swings?
I think so. Yeah. I think it's more normal volatility. This isn't the type of volatility that we saw in 2020 during COVID, during that bear market. We're seeing a return to more average levels of volatility. And I think this month is a great reminder that volatility doesn't just mean that we're moving down. But you look at the month, we've pretty much gone nowhere, but that's because we've seen sharp swings up and down.
What is the favored hedge in this environment? We started the show and we were talking about how in the equity market, in treasuries, and in corporate credit as well, we are seeing trading desks trying to hedge more, and it's getting more expensive to do so. But what are you telling clients?
Yeah, we're telling them to be diversified. We like stocks over bonds, but we don't want them to completely abandon bonds. We've moved a little shorter in duration, so kind of focus on that shorter term and end of the curve. Focus on, short term, maybe intermediate term, to get some of that diversification away from some stock risk. And we also like commodities. So utilizing commodities at this point to really also hedge against that risk. And, especially as commodity prices come down, every time that you get some kind of geopolitical development that might push energy prices down, use that as a buying opportunity to further diversify your portfolio.
Well, I'm curious. I mean, what is the House view right now with regards to the situation in the Middle East? And I mean that in the context of oil and the gas prices.
Yeah, I think there's just going to be, our base case is eventually a resolution, but we don't really have a timeline on that. So there is also that possibility that there's just going to be continued back and forth before there's ultimately a longer term ceasefire and a little bit more resolution there.
All right, Veronica, really appreciate it. Have a wonderful weekend. Veronica Willis, Global Asset Allocation Strategist at Wells Fargo Investment Institute. As we count you down to the closing bells here to close out the day, the week, and the month of July, and all three kind of tell kind of the same story to a certain extent. We're near session highs right now in the S&P, still a relatively narrow rally. It's basically Amazon and a few other names keeping this market afloat. But for some people out there, they'll say, look, this was not a bad earnings season.
Right.
I mean, you had the sell-off in Meta, you had the sell-off today in Apple, and a few other names. But overall, most people seem to think the AI trade is still intact. It's just a matter of what side of it you're more comfortable with.
Do you know what's not working this month or today? Bitcoin.
Bitcoin?
Yep. I'm looking at my screen. It's down 2.7%. It's just, it hasn't. How did Coinbase do?
Well, not good. And, you were here when we talked to Vlad attended yesterday at Robinhood. I mean, the business is doing great overall at Robinhood, but the crypto business not doing great as well. As we count you down to those closing bells, a full breakdown of all of the days, the weeks, and the month's market action now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Emily Grafale. We're taking you through to that closing bell. It's a global simulcast. Carol Masser, she pops up on the screen. Tim Stanovic, he's there too. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube.
Would this be better?
I don't know. For all you radio folks, cover your ears because Carol, who knows what Carol's about to do. A mixed day here on Wall Street. We should point out S&P up, the NASDAQ up, the Dow up, though we're seeing Russell 2000, mid-caps, transports in the red, closing out the week and closing out pretty much what across the board is a down month for at least the major benchmarks here in the U.S.
Yeah, it's kind of interesting to see. I mean, so much movement, I feel like, this last month, but nonetheless, I don't know, we're wrapping up. Overall, little change for the month. I've been looking at the Mag 7. It's up about 3.5% in today's session. So once again, investors moving into these big tech names. Not if you're Apple. Apple's having a really rough day, but everybody else, they're up.
So that's the thing. Tech stocks have had a rough month. It's been a very volatile month, but we are actually completely flat month to date on the S&P 500 right now, despite the ups and downs over the last 4 weeks.
Yeah, the VIX is down as well, at least for today. It's interesting, but, you know, this is kind of what we expect for a July, a summer month. Not too much movement on the index level.
I love your optimism. You are definitely glass half full kind of people. The NASDAQ composite is down 3% month to date. The NASDAQ 100 is down 6.5% month to date. The Russell 2000 is down 3% month to date. The SOX, 21% month to date. Dow Transports, 3% month to date. And we can take the month to date out now because the month has officially ended, at least when it comes to trading here in the cash session for U.S. markets. On the day, definitely a reason for optimism. The Dow adding about 280 points, or 0.5%. The S&P adding 52 points, or 0.7%, closing just shy of that 7,500 mark. The NASDAQ composite up 1% even on the day. The NASDAQ 100 adding about 0.6%. The Russell 2000, though, is going to sit this one out down about 0.5 percentage point.
All right, guys, and the S&P 500, I mentioned, we've been talking about this, almost an even split, a little bit more names to the downside. 281, but I just want to do a really quick thing. Bear with me, Emily, because I just pulled up the S&P 500.
She's actually writing some code right now. She's vibe coding.
What do you think is the big? You guys are wacky. What is the biggest gainer in the S&P 500 for the month overall?
I don't know.
Cognizant Tech Solutions.
I was going to say PayPal.
I definitely would not have got that.
PayPal's number 2. Very nicely done.
I was going to say
Alphabet,
Alphabet, but then I
What do you think is the worst performer in the S&P for the month?
A chip name.
No.
Chip related.
Yeah, that's memory.
It's optical.
Corning.
Corning?
SanDisk.
It's
Corning.
SanDisk.
Oh, you guys, this is a fun game. Corning is the second worst performer, down 37%.
Okay.
Well done, Romaine. But even better is
Does this conversation
Emily.
get better? Where are we going with
Down
this?
40% in the month.
Is
this
SanDisk.
pretty good.
SanDisk, right?
SanDisk.
Okay,
Yeah.
Tim and
So
I got
give
it.
Emily gets the credit for that.
And you
Yeah,
know,
I think I said it first.
You did.
Congratulations, Emily. Thanks for
you said
keeping us
no,
on
then
track.
Carol
By
said
the way, we
no.
get SanDisk earnings next week, too.
Yeah, see?
Yeah.
I just think that's an interesting story. But Emily, let's go to the map.
Okay, let's go to the IMAP. It was a really mixed bag. You know, we have some red on one side, but we also have green on the other side. What was dragging it down? It was information technology, materials, utilities, real estate. Energy was higher. We have seen, you know, on the day, on the month, oil prices moving higher today along with yield. So you do see that energy sector up, industrials as well. Again, a mixed bag. Consumer discretionary also a leader here, at least on the sector level for the day.
All right, I'm feeling really group effort. So I want each of you to go SPX index DES.
No, there was going to be homework.
And do NDX index DES. Look at the 1, 2, 3 top gainers in both of those index.
Yeah, well, without even looking, I know where you're going with this.
But they're exactly the same. So
Well, that's the world we live in right now.
I know. Amazon,
It's an AI world.
Amazon, Dexcom, and then you've got Monolithic Power Systems. Those are the number 1, 2, 3 gainers in the S&P 500 and NASDAQ 100. Thanks for playing along, everybody. All right, so Amazon, let's get to it. Up 15%, man, just surging. The company, we know the story, reported second quarter results that beat expectations on key metrics, including revenue at AWS, Amazon Web Services. That revenue jumped 37% to $42.2 billion. So important. Most of the operating profit for Amazon comes comes from AWS. They've raised their projection for 2026 CapEx to $220 billion from a previous estimate of $200, so up by $20 billion. CEO Andy Jassy saying most of that spending would go toward AI, but nonetheless, investors love. There was so much in that report, but so much that investors like. And again, that's up 15%. All right, number one gainer in those two indexes, as I mentioned. Number two gainer is Dexcom. That stock also moving today, up almost 12%. This is after the diabetes device maker boosted the lower end of its revenue forecast for the full year, following better than expected results in the second quarter. Stock's had a pretty good year. It's up about 25% year to date. Several analysts raising their price targets on the stock, including Piper Sandler, Wells Fargo, Stifel, Baird, Citi, a lot of them. And then the third top gainer in both the S&P 500 and NASDAQ 100, monolithic power systems soaring as much as 19% intraday, but finishing the day with a gain of more than 8%. It's a semiconductor device company, reported second quarter results that beat expectations, and they gave a revenue forecast that is above the analyst consensus. Our BI, Bloomberg Intelligence team, said the results validate the thesis that the company's expanding penetration and diversification across data center infrastructure build-outs are driving growth.
Okay, I got the decliners, and I'm going with all superlatives today. We got to start with Apple tumbling after component shortages weighed on the company's sales forecast. Shares of Apple fell by 7.3%. At one point, this was going to be the worst day going back to March of 2020, which was the COVID panic. Now worst day since April of 2025, which was the so-called Liberation Day panic. The company's services growth will decelerate in the September quarter. It warned of an impact from regulatory changes to its App Store business model in the EU and elsewhere. Shares of Apple once again down by 7.4%. Worst day ever for Roblox since going public back in 2021. Shares just tumbled 27%. Go ahead, Romain.
Yeah, this whole Roblox story, I mean, just going back the last couple of years, just absolutely fascinating. Just, I don't know what the management is doing over there.
Well, I mean, the safety issue is huge, and Bloomberg Business Week has done a great job covering that and what the company.
But they've had so many opportunities to address this.
And maybe now it's starting to hit because you have parents saying, well, we're not going to let our kids on the platform. Daily active users missed analyst expectations. The company's users fell short of those estimates. Bookings also came in lower than expected. Also, the worst day ever for Reddit. This after the company failed to announce any new data licensing agreements in its latest earnings report. Reddit shares fell, remained by 21%.
All right, let's take a quick look at yields. Of course, coming off that big jump up higher that we saw on Wednesday. That subsided on Thursday, but the trajectory back in place here on this Friday. In fact, you take a look at the 30-year yield, where it is today and where it was a month ago. In fact, the biggest jump that we've seen on a monthly basis in at least 2.5 years. All right, guys. What do you want to chat? I mean, let's just let Carol do it because she's just going to go in her own direction. I've been following this FIFA story.
Yeah. From the man who interrupts all the time.
The potential own goal that the FIFA president and Peace Prize giver is doing here with this backroom deal with Joshua Kushner to basically sell off a stake in the commercial arm of the World Cup. And all of the soccer federations, not all of them, but at least the bigger ones like UEFA and CONCACAF basically saying, what the heck, dude? And I mean, this doesn't seem like this is going to blow over.
No, I don't think it's going to happen.
Right.
Yeah. Well, I don't know. I mean, what's to stop him?
Well,
all these.
You should say, Yeah,
UEFA boycotting the next World Cup.
Yeah.
That's what's going to stop him.
Well, that's what they say. That's
so without, as Randall Williams and Vanessa Perdomo Maglione told us earlier, without UEFA, FIFA's got nothing.
Yeah, right. Well, they know their power. I guess the question is, are they going to stand by that? Or, maybe they cut a deal. I don't know.
But they also said the regionals make a lot of money off of their own little, not little, but own tournaments and matches and stuff. So, what are they giving up if they accept?
I just love the drama here, and it just seems like I don't know. I guess he felt Infantino felt like, hey, he's coming off of this high of putting on this great World Cup that was a huge success, despite a lot of the hand wringing, and now he's trying to play that hand into whatever this deal was that he struck without consulting.
I'm hearing we need to take a hydration break.
You seem pretty invested in this.
I am, actually.
Yeah, I can feel it.
I'm a huge international football fan.
We understand you got a lot going on that
every 4
side.
years.
So we're going to let you go.
All right,
have a great and
I
safe...
think we should have left like 45 seconds ago.
You know, that hurts us.
Oh, I love you. Have a great weekend.
Yeah, I love you too.
Yeah.
All right.
Nice
Emily,
being
we're
here.
so glad you're here.
Yeah.
All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Emily and Romaine back there on The Close on TV. Tim and I back here on Bloomberg Business Week Daily on radio. We'll see you again, same time, same place on Monday.
Of course, tech, of course, has been driving this market. A big question is, what does that actually look like in the months ahead? That conversation coming up after the break right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Emily Griffeo.
And I'm Romaine Bostic as we close out this Friday, close out the week and close out the month of July for U.S. equities. We end on a bit of a high note with the S&P adding about 0.7% on the day. That basically leaves it at the waterline on a monthly basis. Most of the other major indices here in the U.S., while higher on the day, did post some pretty significant losses for the month. And of course, keep an eye on oil prices. They continue to move higher. The XOP, which tracks a lot of those oil and gas names, up about 1.5% on the day, and you saw some big moves over the last few days in names like Chevron and Exxon, which just reported huge windfalls because of that big bump that you saw in oil prices. But yields, they were a big story this week. They've been a big story all month, and Emily, they probably are going to be a big story for the next few months to come.
Yeah, it's going to be a focus, especially for equity investors that are focused on tech stocks. We know that sometimes tech stocks do not like higher yields. Amazon shareholders don't seem to mind that company blowing out of the water with its cloud results and its earnings. That stock up 15% on the day, one of the best day in many, many years for Amazon. I also want to highlight some other down movers for the day. Coinbase down 11%. Earnings just not enough to lift the stock. It's been a crypto winter, we could call it. We saw Bitcoin lower today, lower on the month, and it's hitting shares of Coinbase, that cryptocurrency exchange as well. And then finally, Roblox down almost 30%. Call it 26%, 27% loss here. The worst day on record for the gaming company. The company really not able to prove to shareholders that it's focused on child safety, Romaine.
All right, I'm going to go back to the top of that screen there with Amazon and kind of compare that to some of the moves we saw this week with Microsoft, Apple, and the others, because that is our top story for the next hour here. A rocky month for the tech trade, which started this month of July with the two-day swoon and ended it with the two-day rally, just barely, as you saw. There was green on the screen, but how much conviction was really behind that? This month really was a rethink of valuation and a rethink, if you will, that left the chip stocks as a group down 20%. That's the worst monthly performance for the stocks going all the way back to October of 2008. But at the same time, it did hand the hyperscalers like Microsoft one of the best monthly performances that it's had since 2007. The rest of the tech basket, still a jumbled mix of opinions and price action, but a significant jump in hedging activity does show that even if the AI bull market is intact, the unbridled and often blind enthusiasm that we had seen over the past few months has maybe subsided a bit. That is a short-term story, just to be clear, though. And the long-term story is really about the AI tech trade. And our next guest, she's been through a lot of cycles in the tech space, and she joins us right now. She's worked at Google. She was chief of staff for Sheryl Sandberg over at Facebook, was a business lead over at SoFi, has her own company at First, and operating advisor at Bessemer. Libby Leffler, great to talk to you here. And I do want to start off on kind of what we learned, if at all, over these last few weeks about the state of the AI trade, and more importantly, just how much conviction, I think, not just investors in the public markets, but even behind the scenes really have.
Yeah, Romaine, great to see you. Thanks for having me. I mean, this week in particular, so much drama across the Mag 7. Look, I think the lesson is really clear. The market did not punish AI CapEx spending this week, but it's punishing CapEx without a customer. And so we're seeing those results in Amazon and Microsoft. They're showing the receipts, and they're getting rewarded for that pretty generously. Meta has not yet. Ambition is just not enough anymore, and investors really want proof that this investment is going to bear out.
Well, I'm curious about that too, particularly with regards, and I like what you said, the idea that, if you can show that you have a customer there, and obviously Microsoft did that, Amazon did that, Alphabet a few days ago did that as well. Behind the scenes though, and I'm talking particularly with a lot of the startups, whether they're mid or to late stage now, that might be eyeing the public markets here, are these companies sort of set up for that type of scrutiny, or can they maybe just ride, whatever we're going out and maybe send a sentiment shifts and becomes a little bit more euphoric later?
Yeah, it's a great question. I mean, as a startup founder myself, I spend more of my time with venture investors. And so here's my take on this. Like, I do wonder if VC is paying enough attention to the public markets. Typically, VC and the public markets there is some disconnect there. But actually, like every AI company that venture funds today at billion-dollar valuations, and the amounts that are going into these companies are eventually going to have to raise from the public markets. They're way more connected, I think, than people really fundamentally understand. VC has raised more in some cases than it can deploy. And so, to your question, these concentrated bets that are on companies chasing massive ARR curves, there's a couple ways to get there if you're a startup, right? Mm-hmm. One way to get there is to subsidize your growth with token losing pricing. That can work until it doesn't.
And who's doing that in the space right now, token losing pricing?
I think if you are a company right now that is priced to match your VC investors, these massive ARR curves and growth, you have to come up with some way to be able to meet those expectations and ultimately meet what the public markets are going to expect as well when you come knocking on their door to fundraise later.
Libby, I do want to get your thoughts on Meta as well, and just kind of how you're thinking about their long-term vision here and their long-term approach to AI, because this is a company, like a lot of peers, that is just spending a ton. And, you know, some investors are saying they just haven't seen that ROI yet.
You know, that's right. I think when I think about what the mood music is right now, it can seem hard to hear because you look at Meta, which I think is a cautionary tale, and we should talk about that. And then you look at Microsoft. Well, both Microsoft and Meta spent enormous amounts on AI infrastructure. In fact, Microsoft actually outspent Meta on CapEx last quarter, $41 billion versus $31 billion, but the reactions are opposite. And so I think the ambition, of course, Mark's ambition at Meta is huge. I'm not surprised to see him go all in. I think ads are still really strong. Again, lots of ambition there. That is to be expected. And they're certainly not struggling, even though the stock is right now after earnings. Mark is reinvesting significantly, and he believes in it. But investors are just questioning it. They're questioning whether that payoff comes fast enough to justify how aggressive the spend is. I'm holding Meta, and I'm still buying the glasses. So.
Oh, okay. All right. There you go. Just don't wear them around me, Libby. I do want to ask you, I do want to ask you, though, about your business and kind of how it kind of links to some of the issues that we've been talking about over the last few weeks, the idea of AI kind of eating the lunch of a lot of software companies, particularly with regards to professional services. And you run a company called First, which helps to do a prenup, so kind of in the legal space, in that broad legal space here. I mean, you're kind of running this experiment firsthand. And I am wondering if we're sort of looking at this too binary in terms of, it's either going to be, the AI company that takes it all, or it's going to be the legacy company that finds a way to survive. Can they coexist, these two worlds?
I absolutely think they can. I mean, that is really the vision and the mission for why I started First and, what our team is building in the consumer legal space in particular. We really believe that there's space in all of these different categories. My company is in the personal law space in particular for consumers, for there to be, in some cases, a human in the loop where there needs to be in the legal services space and professional services. And AI is a big part of all of our businesses. I think it's massively transformed the way that our customer finds us. We're seeing, double the customer growth month over month just coming from AI alone. So it's a really important part of our business and how we think about education for consumers in these types of professional services businesses. Certainly other startups are looking and feeling the same way.
Libby, really appreciate you taking time for us. Libby Leffler there, operating advisor over at Bessemer and the CEO of First. Coming up, a conversation with the CEO of Illumina. That's next right here on The Close. Shares of Illumina up on the week, up for roughly about 4 straight days, relatively unchanged on the day, but you see that 0.01, we'll call it in the green here. This on the back of the gene sequencing equipment makers. Earnings in the most recent quarter, a beat on several of the key metrics, and more importantly, slight upgrade in its guidance for the year. Jacob Thaysen joins us right now, the CEO over at Illumina. And Jacob, let's start off with the guidance going forward. You raised it ever so slightly, but clearly investors were pleased with that. What gives you the confidence that you're going to meet those numbers?
Yeah, well, first, thank you for inviting me here to the show, and I'm definitely pleased with the quarter. We had a strong beat in the quarter. We raised the second half of the year. So I think that's what you see that our investors have been pleased with. We have had a fantastic performance over the last 6 months where our stock is up almost 50%. But it really speaks to that the strategy is working. The strategy of becoming the infrastructure behind genomic medicine and really providing sequences, reagents, and of course also compute and software into many laboratories around the world where they can take that and take their biological sample and translate that into deep insights. That goes both for researchers, pharma, but more importantly also into clinical labs. Clinical labs are really adopting sequencing, DNA sequencing now to help really ensure that their patients can get a good profiling of their diseases. Well, oncology is the big one there, and we are seeing a lot of momentum in that space.
Well, as somebody who has some personal experience with that, talk to me a little bit more about the clinical side of the business, how much of a growth story that can be, but also the efficacy of the information that is being produced on the spot there.
Yeah, I mean, clinical is now more than 65% of our consumables business, and it's really the growth engine for the company. We are growing in the teens right now, and we think that is a doable growth. We think there's a lot of opportunity here. And the reason for that is that genomic sequencing, it is the DNA is the blueprint of biology. And it's very important for many different specific diseases to understand the genomic profiling, especially for cancers. That is a disease of the genome. But today, it's still not a part of standard of care. So bringing it up to standard of care is going to be essential for really helping patients to be successful in their fight against the different diseases. Oncology, we're starting to do that. We're doing that for selecting the right therapy for people. So our customers are doing that in the laboratories. But you can also go into monitoring when you have gone into remission of cancer. You can use genomic profiling to monitor the disease and ensure you can pick up any signal that will show that the cancer is coming back. That's a tremendous growth opportunity there, and that is the power of Illumina, and that's where we see a lot of opportunities in the future.
Jacob, what about the tools business? How is that going for you guys, and is it still affected by the attempted Trump admin cutbacks to life sciences funding?
Yeah, so you think about the business that we are delivering, and we are providing tools across many different parts, many different segments. And clinical is the big one, but we also are supporting the academic research space. The genomic sequencing is being used to really helping to advance our understanding on biology, advance our understanding of diseases. But it's not only on the DNA level anymore. Now we are shifting, so we're also looking at both DNA, but also all the way up to proteins, to proteomics. And so, yeah, we have been impacted with some of the challenges that's been happening in the funding environment, but I think this will come back, and especially the space that we are in on what we call multiomics is one of the areas that will be invested in the future. But right now, it's something that we see as an upside to our numbers. So I think that will really fuel more growth when that comes back, that market.
What about the new AI life sciences business, BioInsight? Do you think there's going to be more partnerships like that with pharma?
Yeah, so if you look at the opportunity here is that genomic sequencing is very, very data intensive. In each of our cells, we have the genome consists of 3 billion letters. So you have to read that of the biology. You have to read that every time. So that's a tremendous amount of data. So we've used AI for a long time to really understand what the genome actually looks like. But it's highly complicated to combine the genomic information with proteomics information and so on. And you need AI insights to really translate into early signals. So we are starting to sequence and create big data sets that provides deep insight that pharma can now use to really have better predictability in that drug discovery. This is the future. We're just getting started, and I'm very convinced that this will change our understanding on biology. It will revolutionize drug discovery. It will revolutionize how we think about healthcare going forward, and Illumina is going to be a center of that. So I'm very excited about that business.
Jacob, really appreciate you taking time for us. Congratulations on the most recent quarter. We'll talk again soon. Jacob Thaysen, Illumina CEO there, coming off an up week on the back of an up earnings report. Now, when we come back, we're going to talk about a big shift coming in the world of combat sports. Jake Paul's boxing league mashing up with John Martin's professional MMA league, a mashup designed to take on the big heavyweight out there, Dana White's UFC. We're going to catch up with Jake Paul, John Martin, as well as Nakisa Bidarian when we come back after the break, right here on Bloomberg. There's a new contender in the world of combat sports. Most Valuable Promotions and the Professional Fighters League, they're merging. It's an effort to take on the UFC. I had a chance to sit down with the team behind the deal, MVP's co-founders, Jake Paul and Nakisa Bidarian, as well as PFL CEO John Martin. Take a listen.
There's like a massive gap in MMA right now. It feels like the culture is different, and there's just so much space to take over. We've proven that with our partnerships with Netflix and putting on the Rousey-Carano fight. The demand that's there for our events and the events that we put on a consistent basis. And fighters are being treated unfairly in other organizations. I'm sure people know like who I'm talking about, but we've always had the ethos of fighter first. And so giving them the best place, the best destination, making sure that they're paid appropriately and have all the benefits and can still gain the same amount of viewership from the events that we put on. It's just another home that is needed. It's very badly needed. So there's a problem and a solution, and that's us. And that's really all entrepreneurship comes down to, is fixing problems.
Give me a sense, though, of how that structure is going to look overall. And I know, John, we've talked a little bit about also this idea of fighters first and a more, sort of equitable sharing relative to what the UFC and some of the other leagues do. Does it change materially from what PFL had already been doing?
I think this supercharges the PFL in any number of ways. And I've still been at the PFL for a little less than a year, but it was almost as soon as I joined that I really started to pay attention to what MVP was doing and the attention that they were able to grab. Initially, I was focused on their boxing events. But whether Jake was fighting, which of course was a huge global blockbuster event, or whether just promoting, the level of attention that they were giving their athletes was something that I felt was really admirable. So for the PFL, we have better fighters than the average fan realizes. So this is a way for us to shine a spotlight on them and provide a bigger platform at scale. And also the idea here is that combat sports is more than just any one discipline. So being able to be one company that can offer athletes multiple ways to earn a living. If they want to box, they can box. If they want to fight in mixed martial arts, they can do that style. I think it's going to give us a huge advantage. So this really is a combination where I think for the PFL, MVP solves what we couldn't easily solve on our own, and I think vice versa.
I think building off of what he just said there, Nakisa, is what, you have what they needed. And so tell me why this was the right move for MVP. You guys put on your first MMA match in May, and was it from the success of that? But you had said at the time, we're going to do more in MMA. But was it the success of that drove you to the PFL, or what was it that made this the right partnership?
Look, we started this company 5 years ago, and we've been disruptors in the boxing landscape and the content consumption landscape. Brought the first professional live sporting event to Netflix. When we decided to do MMA, I've always said if it was successful, we're going to do more. And what did more look like? Well, more now looks like that we have the benefit of world-class infrastructure, world-class fighters, and the leadership of John Martin as our CEO of the overall platform to go after this opportunity. In the history of sports, you'd be hard to find where there's a strong endemic brand like the UFC and a newcomer to show up and put on an event at the scale at the engagement and at the viewership level that we did. So it's clear there's opportunity to create a second major brand in this sport. And with what PFL has and what MVP has, that's going to be us.
Jake, you had mentioned how fighters, are being treated unfairly in other companies. And one of the things Nakisa and I had talked about before we went on air was how proud you are of Amanda Serrano and the career that she's built and what you guys were able to do together there. So tell me about, what you're hoping to accomplish with other fighters, how you use your platform as a global superstar. You want them to become global superstars as well. How do you do that?
Yeah, I think it's just storytelling, and that's like what I've always been best at since my early days. And even just Team 10, the first company that I created, and creating 30 influencers that were the biggest on the internet, and essentially doing the same thing now in the boxing and MMA world is building other personalities up and other talent up around me. And Amanda Serrano was a perfect example of that, where she was getting paid, $1,000, $5,000 a fight. And she's one of the best fighters in the world. And so really all I did was shine a spotlight on her that she, deserved but didn't have. And the rest is history.
Can you share kind of what kind of share fighters will get out of this combined MVP PFL?
What do you mean, like
in terms of revenue share?
In terms of revenue share.
The focus has always been to at least provide 50% of revenue to athletes, right? So when we look at the traditional ball and stick sports that achieve those types of revenue share metrics for the athletes, all of those entities have created massive amounts of enterprise value. So Jake and I's belief from day one, the first day I met him in 2019, I walked into his house. I actually didn't know who he was prior to the meeting being set up.
You didn't know who he was?
I did not.
Oh, really?
I did not. And
lived under a rock.
and he said, I want to be a fighter, I want to be an actor, I want to be a rapper, I want to be a content creator, I want to be an entrepreneur.
Yeah.
And I was like, well, that's a lot of things. He goes, but most importantly, I want to start a fighters union.
Yeah.
So I want to make sure fighters get paid well.
Yeah.
We're the talent, we're the IP, we deserve fair share.
Yeah.
And if you look at other sports, when athletes get fair share, they're more invested, they're more committed, the product is better, and there's total cohesion.
Well, I'm curious, Jake. I mean, where are you all going to be in this whole mix? Are you going to be more behind the scenes, or are we going to see you in the ring, in the cage, going forward with this new league frequently? I mean, you kind of teased an MMA fight with this merger announcement.
Yeah, both behind the scenes on the business side of things.
Yeah.
Especially as it pertains to marketing and being a voice and promotion of all of our fighters. But that it's kind of this like flywheel, because also when I fight, it's some of the most viewed fights ever, and so we can uplift our fighters on the undercard. And that's actually what happened with Amanda Serrano. Is that at first we started putting her as like the co-main event on my fights to build her up. So it's this flywheel where when I fight, it's actually boosting the whole, company's enterprise value. And
you have the star power. And just be clear before we go anywhere. Are you able to fight now? I mean, your jaw and everything back. I mean, physically, are you ready to get back?
Yeah, I mean, not currently, but in the next couple of months, I'll be cleared for sparring. Okay. Yeah, so the jaw is like still healing, but just gonna hopefully get back in there later this year. We have negotiations to work through potentially next year, and then wanting to do MMA. I have a wrestling background, Division I. When I see these MMA fighters wrestling, I'm actually embarrassed for them. They wouldn't last a minute in Ohio Division I high school wrestling. Yeah. So excited to go into MMA and showcase my skills there next year.
John, for you in the PFL, what are you most looking forward to working with MVP and, like Jake mentioned, his following and all of that? And how do you think it's going to change your business? How is it going to change having MMA and boxing under one roof?
I think, just to echo what I said a little bit earlier, Jake I referred to him yesterday as a unicorn because he's an athlete, he's talent, he's a promoter, he's an influencer, and he's got the biggest megaphone that anybody could ever ask for in terms of a promotion.
Talk to me about media rights as well. You had on one hand you had the ESPN, on the other hand you had Netflix, which of course. And what is the Netflix commitment to this? Is that, I mean, are they committed longer term to what you do?
We have a long-term relationship with them that we haven't disclosed the terms of, but we've put on 4 events with Netflix.
So you think they're serious about a commitment to not just
I mean, they're serious in the commitment to sports. They're serious in their commitment to MVP. Right? We brought professional sports to Netflix. The first ever professional sporting event was Jake Paul versus Mike Tyson. And we look forward to meeting with them in short order and figuring out more events to do together.
So with the merged company, you have between the hodgepodge of deals, ESPN, Netflix, Sky, I think I'm forgetting a couple of others. Is the idea?
Those are the three MVP core partners.
Those are the three core
PFL
partners.
has 40+ partners internationally as well.
Is the idea to keep that fragmentation, or maybe are you looking for one sort of gigantic umbrella media deal?
I think when we think about the brand architecture and the different athletes and how they service each of those, we'll figure out what's the right distribution.
I have to address the elephant in the room because I think both you and Eddie Hearn, and I don't want to speak for Jake and John, you know, there is sort of a competition with Dana White and UFC. And I am curious as to how you're positioning this new MVP up against that. I mean, they've got obviously the big backing with TKO, the big deal with Paramount and all that. So you're going up against a force in terms of, no, from a business perspective and probably in a lot of other ways as well. Are you staring him down head on? And are we making too much of that?
Yeah, 100%.
100%.
Yeah, that's it's war as far as I'm concerned. We're here to make MMA great again. And there's so many things going on behind the scenes, back and forth. Mostly them attacking us, manipulative things. I can't even be in my own brother's WWE matches because TKO has blocked it. They don't want me to get any publicity from the WWE. So there's so many things going on behind the scenes. It's war, and it's only going to get crazier. But it's Coke versus Pepsi. It's Nike versus Adidas. This is exciting.
Is it really even a question? Does it have to be a question? Does it have to be a topic of needing to be number two, having to push UFC? Or is it just focus on doing what you're doing and potentially change the entire market? Like Nakisa was saying, if everyone raised fighters' pay, maybe that's great for everyone in the sport.
I think it's a little bit of everything that you just said. In other words, when you look at, before I decided to come to PFL, I convinced myself that UFC was not going to be a winner-take-all. The world is too big a place. There's too many fight fans. Fighting as a sport is primal. It really has no borders. As Jake said, if you're a fan, you could be watching two Africans fight from the continent of Africa and be equally as enthusiastic in that as you would if it was, you know, fight somewhere else. I think that it provides a tremendous space and opportunity for us to bring great events. And like I said, it could be MMA, it could be boxing, we could do hybrid events. And it's really just about finding great athletes, finding great fighters, putting on great events, and delighting the fans. I think there's a huge amount of space, but scale matters. It's always mattered in the businesses that I came from. I was a builder. I built big businesses. I scaled existing big businesses. And this combination is going to give us scale to move faster. And speed matters.
John Martin of the Professional Fighting League merging his company with Jake Paul's and Nakisa Bidarian's Most Valuable Promotions, a big mashup in the business of sports. Meanwhile, some breaking news crossing the wire just a little while ago. This from the New York Times, that the Fed may be considering reducing the frequency of its meetings. Now remember, since 1981, the Fed meets roughly every 6 weeks, so about 8 meetings a year. But according to the New York Times, citing 4 people familiar with the discussions, that at the most recent meeting, new Fed Chair Kevin Warsh floated the idea of reducing the number of regularly scheduled meetings. Does not actually say how many they are considering, but the report does say the decision could actually be made as soon as the next meeting in September. We're going to get you some more details on that. This is Bloomberg. Luxury real estate firm Serhant continues to get bigger, making a move into Texas. It follows a string of high-profile companies like SpaceX and Oracle that have moved their headquarters to the Lone Star State in recent years, and Serhant, of course, chasing that money down. I had a chance to sit down with the CEO and founder of the agency, Ryan Serhant, and get his thoughts here on just how far he plans to take this business. Take a listen.
Texas has always been popular, but I'm not excited about Texas because people are moving there. I'm excited about Texas because of job growth. There are 3.5 million startups and small businesses in Texas, more than any other state. There's more Fortune 500 headquarters in the state of Texas than in any other state. And then that combines directly with the amount of single family and multifamily apartment sales and homes and leases. There were 14,400 residential sales over $1 million just in the past 12 months. That's $25 billion in transactions. That is more than in any other state. So it has become the entrepreneur capital of the United States, and it's important markets for us to be in, and our agents and our clients have demanded it. So here we are.
Entrepreneur capital of the United States. You know, there's some folks out in Silicon Valley that might take issue with that. They're doing pretty well over there too. You know, there's this thing called AI. A lot of money is being generated from that. I would think the housing market in the Bay Area, even in the LA area, should be doing well, right?
The Bay Area pricing has increased 10% year over year. Actually, sales of homes over $5 million in San Francisco have increased 70% year over year, in part fueled by the AI secondary boom. Sales of $10 million properties in San Francisco year over year have increased 30%. And the average luxury home in San Francisco is 333% higher than the average luxury home in any other market in the United States. So yes, there's a lot of money there, but it's small. Texas, big. So geographically, it's an important place for us to be. And we're in both. And so we're able to do deal flow between both. And the markets in both are on fire.
Yeah, and I was being a little tongue-in-cheek. We talk a lot on this show just about the build-out that we've seen in the South, finance and everything that around it, the Space Coast, obviously tied to SpaceX, and the build-out that we've seen in Houston, in Dallas, Austin, and of course down in Florida. As you sort of look at those trends and you try to sort of position Serhant as a business, is this long-term structural, meaning that we'll be talking about these cities in the same way we talk, these housing markets, the same way we talk about New York or San Francisco, LA?
I think so. Yeah. What makes New York and London and San Francisco and Hong Kong so special over the past hundreds of years is that they are waterlocked. You can only make them so large. So the big difference in a state like Texas, I mean, Houston, as a metropolis, is the size of the state of Connecticut, okay? And it can keep expanding, which is exactly what it does. You know, north of Texas, we have listings now north of Texas. I was just there 2 days ago, seeing our first properties and meeting all of the agents. You know, we're in Frisco, and Frisco was incredibly popular. It's incredibly popular, but now they're competing with Prosper. And then there's going to be a new multi-plan development, and then another one, and then another one. So you can continue to expand in and around the Bay Area. It's hard to do that. And so,
do clients or potential clients down in those areas, do they look for some of the same things in terms of location that they would look for in a city like New York, meaning proximity to their work or proximity to, you know, whatever the main commercial center is, or is that less of an issue in this Texas city?
Definitely, you know, in the middle of COVID, people were location agnostic. Today, there is a demand to get back to IRL dinners, IRL meetings, get off Zoom, turn your cameras off, meet in person, let's hang out. But there are 4 Americas right now that we are working with in this housing obstacle course that we find ourselves in. You have cash buyers, you have buyers who need financing, you have owners who are locked into 3% rates, and then you have builders who want to build as much as they can, but they can't outrun costs. And it is a tricky environment, which is why overall transaction volume has dipped just a little bit, and we're gonna go on up and coming here. I think year 4 of 4 to 4.2 million trades in the United States. You know, in 2007, that number was 8 million.
Wow,
that's too high. 4 million, too low.
I'm curious, with the second and third points you made about, of course, where mortgage rates are, basically the people who have to borrow, and then the people that are kind of locked into that 3% in what is now a 6.5% world. I mean, I was looking at weekly mortgage applications, which just came out today. If you look at the trend line, we're averaging 159,000, which is well below long-term averages. I think pre-pandemic we were, you know, close to 300,000. I know a lot of the business you do traffics more in people who don't necessarily need mortgages, but have people gotten comfortable with 6+%? I mean, because I understand the shock of that a couple years ago when you were so used to hearing everybody getting 3%, 4%, even 2-point-something% mortgages. But I feel like at this point, if you're buying, you just kind of have to accept the fact that you're going to pay 6%.
Imagine being on a sinking ship in really cold water. You can stay on the boat, but if you want your family to get to the next boat, you have to jump in the water. You don't want to jump in really, really cold water. It's uncomfortable. And but you do it, and you get used to it, and you rebalance your monthly, right? That monthly payment. People don't live in the purchase price. They live in the monthly payment. Now, in New York, 75% of the transactions are all cash. nationally, 25% of the transactions are all cash. That number is very high. And most of the first-time home buyers are actually being financed by the baby boomers and Gen Z, the Gen Xers who created this whole process in the first place. And so a lot of that cash is going from the wealth transfer. And we're seeing that too across the board in all assets, whether it's commercial, residential, agricultural. We are in a property transfer, the likes of which I've never seen in my career.
And part of my conversation there with Ryan Serhant, the CEO and founder of the real estate firm Serhant. You can check out the full interview online on Bloomberg.com. Stick with us. We're going to wrap you up for the week and set you up for what to watch in the next. That's coming up next, right here on Bloomberg. All right, it was an incredibly busy week here in the U.S. for equity markets. Next week, it's also going to be pretty busy as well. We start off on Monday, a couple of light economic data points to keep an eye on, ISM manufacturing and those S&P global manufacturing PMIs. But we're also going to start to get some more earnings, a much broader swath of what's going on out there from Marriott, Snap-on, but two tech stocks to keep an eye on, Palantir and onsemi. Palantir has been an underperformer all year long. onsemi down about 30% in the past couple of months. Those earnings come out after the bell on Monday. On Tuesday, the earnings palooza continues. And keep an eye on SpaceX. This is going to be the first quarterly earnings report from the company as a public company. We kind of have a sense of the numbers, but of course, a lot of focus will be on just how Elon Musk is able to talk up his vision for the future. We're also going to get AMD that day, McDonald's, Pfizer, Apollo, as well as Paramount Skydance. Put a pin on that one for a second. Also on Tuesday, we are going to get some primary elections here in the U.S. It could be critical, including in Michigan and in Missouri. On Wednesday, we get the ADP employment data, but we get back to earnings. I said put a pin on Paramount Skydance because we had Disney earnings on Wednesday morning. We also get Uber, CVS, Novo Nordisk, Eli Lilly, and SanDisk. But that then rounds us out into Thursday, where we're going to get results out of Warner Brothers Discovery, and of course, a lot of questions about whether that Warner Brothers Paramount Skydance merger will ever actually indeed go through. Some additional earnings from Airbnb, Sweetgreen, and Cloudflare. And keep an eye on the sky. NASA astronauts scheduled to conduct a spacewalk outside the ISS on Friday. It is a jobs Friday, a very consequential one in light of what we heard this week out of Kevin Warsh and the Fed. We appreciate you joining us here on The Close this week. I'll be back next week for all your market-moving coverage. For all your political coverage, stick around. Joe Matthew and Kayleigh Lyons are up next, right here on Bloomberg.